Let's discuss the difference between cash basis and accrual basis. We start this portion of the module where we're cooking the books using cash basis. The bank has requested that you give them a income statement for the month of May, and it didn't specify whether to use cash basis or accrual basis. So you're being sneaky, and you have approached your customers and they've been willing to give you $3,000 in cash on May 1, and that is 3 months worth of mowing revenues for you that you're collecting in advance. We'll talk about this after. The cash paid for gas during the month of May was $200. And as far as your cash paid for wages, you didn't pay any wages in May. Okay, so that, the green, is our cash basis, because with cash basis, you're going to record the cash from customers as revenue, and then the bills you paid would be your expenses. So if you look at this, our net income is $2,800, 3,000 minus 200. We've been, with the cash basis, able to ignore the brothers' wages because we didn't pay them. So we've severely inflated our net income. But let's now look at how accrual accounting would not have allowed that. To begin with, those the rents, you've only earned 1 month's worth of revenue in May. So you're not allowed to be recording over here $3,000 of revenue for the $3,000 of cash that you received. The difference, which will show up on your balance sheet, is a liability. And that liability represents the amount of revenues you have not earned yet. Okay, so unearned revenue is revenue waiting to be earned. So you can see here now we're recording truly what was earned, not just what was collected. Now with the wages, if you look at the wages, even though you did not pay the wages, you still, according to the expense recognition principle, you've got to match all the expenses you incurred that helped you to generate the revenue from the period, which is the 1,000. So your brother was the one, let's say, who mowed the lawn. So the expense of your brother's wages should be matched with this revenue, even though you didn't pay for it. So if you look at this, we are going to record the expense of 500, and instead of having cash be given up, what we're giving up is an IOU. You owe 500. So your income statement is going to show the wages expense. There will be no cash paid, but your balance sheet will explain that you still owe it. So here's a summary comparing the two. Net income is inflated under cash basis and easy to manipulate. And then net income under accrual accounting, which is your revenues minus expenses, and in substance this is what you truly earned, and this is what you incurred in generating this 1,000 in revenue. So 300 is a better measure. Now accrual accounting better depicts the operations of the business, and that's why cash basis is not allowed. The GAAP, the rules say accrual accounting, not cash basis. It's too easy to manipulate. Let's take a quick look at the financial statement so you can see how the income statement and the statement of cash flows will have different amounts. So here we have revenues of 1,000, but the cash collected from customers is 3,000. The balance sheet will explain that difference, and here's the 2,000. So it links the two, saying, yeah, you collected 3,000, but you haven't earned all of it. There's 2,000 yet to be earned. Likewise with the wages expense, you've got the amount that you've incurred during the period, but you look here, there's no cash paid for wages. That actually wouldn't even show up on there. I just left it in there for example. So the balance sheet will say, well, that's because we are owing that amount of expense. We have to pay that next accounting period. And briefly, when you get to the next accounting period and you pay your wages, what you'll do is then see cash paid for wages minus 500 there, and this will go away. I'll show you that here. Sorry. When you pay your wages in June, you're going to decrease your cash and decrease your wages payable, making your wages payable a zero balance. I hope that helps you understand the importance of accrual accounting, and also the reason we need all three statements: the income statement to show what was earned and what was incurred, the cash flows to show what cash came in and what cash came out, and the balance sheet to explain the differences.